Imagine a single, lightweight indicator that quietly flags when professional money is changing the market's trajectory, but only if you know how to read its subtle breaths. That's the Vortex Indicator. Most traders see two lines cross and either panic in or miss the trade entirely. In this video, you'll learn the right questions to ask when the Vortex speaks, so you stop chasing fake momentum and start trading where the edge actually lives. The Vortex Indicator is deceptively simple, two lines that measure directional movement. Yet the simplicity is what makes it powerful and dangerous in inexperienced hands. In part 1, we'll cover what the VIE actually measures, how it differs from ADX, directional indicators, common failure modes and how to avoid them, a compact entry-exit system you can test immediately, practical risk rules and trade management. I'll weave in short, verifiable examples and leave you with a checklist you can use right now in your simulator. Later parts show how to combine VIE with volatility filters, volume fingerprints, and an automated backtest you can run in Python. But first, the foundation. Think of price movement as a river. The Vortex measures the distance water flows in one direction between two time periods and compares it to distance flowing the other way. Concretely, Vortex has two lines, VII plus and VIR. Each line is essentially a smoothed ratio of directional movement to change. When VII plus VIR, the recent directional movement favors up. When VIR plus VII plus, it favors down. Crossovers are information, not commands. They tell you which direction has momentum relative to recent volatility, not absolute certainty. Why this matters? Unlike plain moving averages that smooth price, the VII relates directional distance to overall range, which helps in markets where swings are meaningful, but choppy noise abounds. Treating every crossover as entry, crossovers are context sensitive. Many false signals occur during low volume chop or when volatility collapses. Using a single time frame only, a VI cross on a 5-minute chart without agreement from the 1-hour chart is often a trap. Ignoring volatility, if the average true range is tiny, a crossover may not be tradable. Conversely, huge ATR can make signals too noisy. Bad stop placement? Traders put stops based on percent rather than structure. The VI gives directional bias, but structure should detect location. We'll build concrete filters that drop false triggers by a large margin in later parts. Example instrument, Euro USD. Suppose you observe 1 hour VI plus, 1.2 and VIC, 0.8, 15-minute VI plus, crossing above 0.9 from below ATR on 15-minute is at recent average interpretation. Higher time frame shows upward bias. Intraday momentum is turning positive. Volatility is live enough to consider an intraday long. Entry signal still needs price structure confirmation. This is an illustrative scenario, not investment advice. Always backtest and demo. Use this as a crisp, testable framework. Higher time frame bias. Confirm the trend on a higher time frame, VI plus VIR. Lower time frame trigger. Wait for the lower time frame to show VI plus crossing above VIRG. Price confirmation. Enter after a clean struck confirmation, either a candle close above recent swing high or a retest that holds support. Volatility filter. ATR must be at least 0.89 of its 20-period average to avoid microchop. Risk placement. Stop below the nearest structure, swing low, or a percentage of ATR, whichever is larger. Targeting. Aim for risk reward 1, 1.5 minimum, or scale out in 2 parts. Why this helps? These rules filter noise, align higher time frame context, and make stops structural rather than arbitrary. If the lower time frame CVI lines recross against your trade and price closes beyond your stop, accept the stop. Don't argue with the market. Use a trailing stop based on ATR, not fixed pip counts. Markets expand/contract. Trailing by 1.1, 1.5 to ATR lets winners breathe without giving back all gains. If the higher time frame reverses, consider tightening stops or closing position. Bigger TF reversals often precede larger moves against intraday positions. Tease. In part 3, we'll show how to automate this exit logic so you don't have to babysit every trade. You don't need code to test initial edge. Run 50 demo trades with these rules on a single pair or instrument. Market your choice, pick the most liquid. Time frame, higher, sell a 1H, lower, sell a 15 meter. Rules, follow the entry exit above. Record, entry time, entry price, stop, target, ATR, result. Notes. Look for win rate, average win-loss, and biggest losers. If winners are tiny and losers large, adjust stop logic and consider stricter, higher time frame agreement. VI can lull traders into false confidence. It shows strength, not inevitability. Treat it like a compass, not a command. Over-optimization is seductive. Don't overfit to a single instrument. Validate across asset classes and timeframes. Size properly. Small position sizes while you validate reduce emotional mistakes and create clear feedback loops. VI measures directional distance relative to range. Contexts matters. Crossovers of signals, not orders, require higher timeframe agreement and price structure confirmation. Use ATR-based volatility filters and structural stops to avoid chop. Demo 50 trades before committing real capital. Track ATR, TF bias, and outcome reasons. The indicator is one piece, combined with risk management and a dispassionate checklist. We'll add volatility and volume overlays that cut false signals dramatically and demonstrate a real case study across 3 markets. If this helped, like and subscribe. Part 2 will show the volatility filter plus a live coded backtest you can run in Python. Drop a comment. What time frame do you trade most? I'll tailor the next video to that.